So good. So thank you. So we're here to talk about financial planning. A lot of this stuff is not real relevant for you right now, but it certainly will be in the future. So I encourage your participation, and we're just going to go through this, okay? And feel free to ask any questions as we go along, okay? So we're going to start out with a quiz, okay? The quiz is, can you see that? What was the U.S. personal savings rate in April of 2021? Any guesses on that? Multiple choice, come on.
Pick one.
D.
In April of 21.
D.
Negative 1.1.
So what was happening in April of 21? The whole COVID thing, right? So people couldn't go out and spend any money to speak of, right? So the answer to this is C, 11.9. So that's a very high savings rate compared to historically. Because there have been times when I've done this presentation and it's been a negative amount. So people were spending way more than they were saving, okay? All right, so here's the second part of the quiz, or the second question. The New York Stock Exchange is located where?
New York.
Very good.
Excellent. Here's your honor roll.
All right, okay. Overall, which is the best source of information or investment news and information? Your parents, anonymous email, a stock market chat room, or the Wall Street Journal?
D.
The Wall Street Journal.
The Wall Street Journal, correct. Okay. If you are in your 20s, based on historical performance, which is the best long-term investment?
C.
A house.
A house? No.
D.
D, a growth mutual fund. Can you see this? Are you okay over there? Okay. All right. So a growth mutual fund. And what's happened with the stock market this year?
It's drop.
Drop. How much?
A lot.
Quite a bit, yeah. We'll leave that for now. But it has. Okay. Ups and downs in the market, right? All right. True or false? A higher rate of return on an investment means greater risk.
True.
True. Okay. When an investor diversifies his investments, does the risk of losing money increase or decrease?
Decrease.
If you diversify, okay, so you're spreading your money out into different buckets of money, okay? We're not going to get into a lot of details. This is a kind of a broad overview of what financial planning is all about, okay? So Sam has saved $12,000 for college, okay, by working part-time. He will start college next year and needs all the money he saved. Which of the following is the safest place to put that money? Which one is the safest? And he's going to be using it.
C.
No, a bank savings account. That's the safest place between all those options. First, because it's a short-term need and he's going to be using the money soon. Okay? Retirement income paid by a company is called? Nope, not 401k.
D.
B, a pension, right? Pensions are kind of going away because it used to be that you'd work for a company for a really long time and then they'd pay you this retirement income. It's called a pension, and the companies are pretty much doing away with pensions because they don't want that. It's just a huge liability for the company, and it's a bad thing for employees because they don't have a pension anymore. But they've replaced it with the 401k. Okay? All right. What was the average credit card balance in 2021?
Credit card.
Credit card. Who has a credit card in here? Anybody? A credit card? Lots of people have credit cards. Is it a credit card or a debit card?
And both.
You have both, okay? All right, so any guesses on this?
C.
Somebody said C, that is correct. The average credit card balance.
So that's the average.
That's the average, okay? We'll talk more about that, the credit card thing, pretty soon, okay? So, here's some statistics on credit cards. The lowest credit card balance is in the state of Wisconsin. That's what it is. The highest is in Alaska. The average interest rate is 16.44%.
Whoa.
Okay? And Americans owe $998 billion in credit card debt as of July of 21. Okay? That's a lot of credit card, right? All right. So credit card balance, if you got a balance of $10,000 on a credit card and the interest rate is 18%, your interest on that is $1,800 in a year, right? That's kind of obvious, right? Here's a real life example. So I have an American Express card and I have another one, but my balance, I looked at this some time ago, and at the time the balance was $952. And if I made the minimum payment due was $15. So American Express company they really kind of want you to pay the minimum, don't they? Why is that?
It's the interest code.
Right, because they're making a lot of money on the interest, right? So it said, and there's a disclosure on the credit card statement that says this: if no more charges and only pay the minimum, it will take 9 years to pay that off. Okay, and instead of paying $952, I'm paying $1,630. Okay, so you don't want to get too wrapped up in having a lot of credit card debt. All right. So I'm a certified financial planner, and there are 6 areas of financial planning that I address when I do financial planning with clients. Okay. Financial position, protection, planning, investments, taxes, retirement, and estate planning. So those are all 6 distinct areas that I help people to address, okay? So the first, financial position, we talk about net worth, we talk about cash flow, and we talk about cash reserves. What is net worth? How do you define that? Everything you have, that's correct, minus what? Any?
Assets?
Huh?
Assets?
No, assets is what you own. That's the same thing as what you said, right?
Any debt?
Debt, that's correct. So it's liabilities or debt. So net worth is everything that you own minus whatever debt you have. That is your net worth, okay? Cash flow is basically income and expenses. What are you bringing in every month, and what's your outflow? What are your expenses? Okay, and we'll talk about the details of that. Okay, and then cash reserves. The College for Financial Planning says that you should have 3 to 6 months of expenses in a cash reserve position. Okay, so what's an example of a cash reserve? Anybody? What's an example of a cash reserve?
Some of you got this.
Most of you probably have this. Nope.
Savings account?
Savings account, right. Savings account, checking account, right? That's money in a cash position that you can get to anytime. That's cash reserves, okay? It's not invested in the stock market or the bond market, okay? It's just in cash. You're not going to make anything on it, right? Because interest rates are so low. But it's also not going to go down if the stock market goes down, right? Okay. So the next area is protection planning, okay? Under protection planning, we talk about all of these things. We talk about life insurance, disability insurance, health insurance, car insurance, homeowners, and long-term care. So lots of different insurances, okay? For you guys, right now, not a big deal, but who has auto insurance, right? You guys all have car insurance, right? Anybody paying any premiums for that? Sometimes over the years, some of your classmates have paid their own auto insurance premiums. They're pretty hefty, right? Because you're young and the insurance company thinks that you drive kind of wild, and so they're going to charge you more. Kind of how that works, right? Okay.
Kevin, do you know, because we talked about this last week or sometime, at age 25, do they still drop premiums, auto insurance companies? They still reduce premiums?
I think so. I'm not a property casualty agent. I
Right.
don't really do that. But I would agree, I would say that's true, yes.
Okay.
Okay? As you get older, and even, now you can put a device in your car and they'll track how fast you're driving on average, and they can give you points. They can give you a discount for being a good driver, right? And if you're a good student, they'll give you a discount for that, okay? All right. But a lot of protection is all about insurance, okay? All right. Investment planning is the third area, and in investment planning we talk about accumulation goals. So I sit down with people and help them to identify, well, what are their goals for the future? And accumulation goals could be car, could be education for their children, home improvements, travel, purchases, all kinds of things, right? And so I help them to define what the goal is and when they want to reach that goal, and then set up some kind of a savings program of making that happen, okay? The other element of investment planning is asset management, right? So we do asset allocation, we talk about risk, and then your time frame for the goal. So the best thing you guys have going for you now is you've got a lot of time on your side to accumulate money. I know it's the last thing on your mind in terms of trying to build money for the future, especially for retirement, because that's a long ways away. But let's say you want to buy a car a few years from now. This is the time to start saving the money to do that. Okay? You can go to the car dealer and you could go to the bank and you could take out a big loan and have a car payment for the rest of your life, as many people do. But the preferred way to do it is to save ahead of time, pay the cash, and then you don't have car payments. So for instance, I've never had a car payment, right? I've never had a car payment. I've never paid any interest on a car payment because I've never had a car payment, right? That's the way that you make your money work for you, right? So that's a good thing to keep in mind. And that's kind of a short-term, intermediate-term goal for you that you could think about, okay?
By the way, he's the only guy that I've ever known that does that, because it takes a little discipline, financial discipline and planning and all of that. But it's certainly the smart way to
Yep. Okay. Any questions on any of that? Make sense? Okay. So the fourth area that we talk about is taxes. Everybody wants to reduce their income taxes as best they can, and there are legitimate ways of being able to do that, okay? So we talked income tax reduction, that's what I just said, okay? So a traditional IRA is one thing that even you could do now. What does IRA stand for?
go. Here we go.
Anybody know?
International Revenue Association.
No? Good guess.
That's not bad.
Anybody? IRA.
It's not Irish Republican Army.
That is true.
Does it have something to do with like Roth or something?
Close, very
In the
close.
ballpark.
Individual retirement
Association.
account. Okay? So an IRA is an individual retirement account. So it means you put money away for yourself, and you could do, even now, if you guys made $6,000 in a year, you could put $6,000 into an IRA. And I'll go into a little detail. A traditional IRA, you can deduct the money that you put into it, like $6,000 if you put that much in. You can deduct it on your tax return, and then you don't pay the taxes on the $6,000 because it's a tax deduction on your tax return. Okay. The alternative to that is a Roth IRA. Okay, a Roth IRA, you don't get a tax deduction, but you put the money in and it grows tax-free, and you take it out tax-free in retirement. And that would be a great thing for you guys to do at some point in the next 10 years, right? You've got a lot of time on your side, and a Roth is going to be a valuable tool that you can use to fund retirement for yourself, okay? And then a 529 plan is a college savings plan. Each state has their own plan, but perhaps your parents have a 529 plan. And they can, and you can even tell them this. You can tell them this stuff. They can put $3,522 into a 529 plan for your education and get a tax deduction on their state of Iowa tax return. So that's a nice helpful thing from a tax standpoint. And then that money grows, and then they can take it out for education tax-free. And you can use 529 plan money for even Heelan's tuition. Okay? That's a nice thing, okay? So those are a couple of things for as far as trying to reduce taxes. And it's, like I say, it's an Iowa tax deduction on the 529. The fifth area is retirement planning. Any questions so far? I'm not boring you to tears, am I? I hope not. Okay. So retirement, okay? Retirement planning, we talk about, and I help people with these things. You know, when do they want to retire? How much do they want to live on in retirement? If they have retirement plans through work. And then I talk about an IRA or a Roth IRA. These are all different things. And then we talk about Social Security, right? Tell me about, anybody know anything about Social Security? Do you get income from Social Security in retirement?
Yes.
Right? That's one of the main sources of income for a lot of folks, right? When can you take Social Security benefits? When can you start taking the money? Anybody?
Mature adulthood.
Somebody said 65. That you can start at 62. Okay? You get a reduced benefit, and the Social Security benefit that you get is based on years of working and how much you've made when you've been working and how much you've paid in. Okay? You can start taking it at 62. You can delay it to age 70. If you delay it to age 70, you get a lot more. Okay? And for me, my age where I get what they call the full retirement age is 67. For you guys, it might be down the road. It depends. They're gonna change probably. People are living longer. For you, it might be 68. It might be 70 before you can start taking Social Security benefits. But we'll see, right? But that's a big part of retirement planning. And then 401ks. You brought up the idea of a 401k. We talked about that briefly. It's a plan through your employer where you can save money for retirement. Okay? Questions on any of that? Okay? Estate planning is the sixth area, or the final area that we address when we talk about financial planning. As you can see, there's the casket. It's estate planning. It's about what happens with your net worth, your assets. What happens with your assets when you die? Okay? And I've got here wills. Ask your parents. Okay, so what's a will? Anybody?
It's like who you leave your stuff to when you die.
Yep, that's right. So it's a legal document that says where you want your assets to go upon your death. Okay? And what I said, ask your parents, because I would encourage you to ask your parents if they have their wills completed, if they have their wills done. My guess is 50% of them don't have one, don't have a will, and it's an important document, okay? So I would encourage you to ask your parents if they have their wills completed, okay?
That's a really good question to ask your parents. And if they say no, don't be afraid to bug them. Because if they die without a will, that's a real problem for the rest of the family, figuring that estate out. And you could conceivably lose a lot of money to the state. You know, if you don't have that will laid out, it could, a lot of it just goes to the state.
And to attorneys, right?
Yeah.
Attorneys, estate planning attorneys, that's the stuff that they deal with. and they get a percentage of whatever your probatable assets are. So it's best to get a will done, right? And any types of accounts that you set up, any kind of financial accounts that you set up, whether it's at the bank or of some financial firm, whatever it is, or a 401k or an IRA, any of those types of accounts, you can name a beneficiary, and you should. You should name a beneficiary, and then it avoids going through probate, right? So it just goes directly to those named beneficiaries, whoever they are. Okay, so that's a good thing to remember, right? All right. Power of attorney is a document that says that if I become disabled, then I want to have this person serve as my power of attorney, okay? And if I become maybe not disabled, but incapacitated, okay? If something happens to me, and it can happen to anyone, as you know, right? Get in a car accident, you can become incapacitated, and a power of attorney is a document where you're naming someone to serve in that capacity, okay? Living wills is another estate planning document. And then you can set up trusts as well. Not mandatory. For most of us, probably not even necessary, okay? But those are all things having to do with estate planning, okay? So the focus for today is primarily on financial position and investment planning, okay? As far as cash flow, so what I put here is to save first and then spend. In other words, part of your budget to have saving as one of the primary things that you're going to commit yourself to save on a monthly basis, just depending on where you're at financially and how much you can do, right? But save first and then spend is an important thing to remember. Delayed gratification, that basically means delaying the purchases of certain things that you want until you have the cash to get it, right? Kind of like, you have to have a car for the most part, right? But if you can save ahead of time, have all the cash, and then pay for the car, that's better than having a car payment and paying interest over a long period of time, okay? So that's delayed gratification. And then don't spend money that you don't have. I think that's a good thing. And a lot of people do that through the use of credit cards, right? My dad always used to say, if you can't pay that credit card off in full every month, then you're spending too much, right? And to me, that makes sense, right? So you want to pay it off in full every month. Some of you have credit cards, right? You get the statements in the mail, or is it all online? Anybody?
It's online.
It's all online. So you get a statement online, you look at the email, then what?
I can pay it online, or I can pay it at the bank.
Yeah, okay. All right, good. And I'm going to have a thing on credit versus debit cards in a minute, okay? Okay, so a definition of discretionary income, we're talking about cash flow. Discretionary income is the amount of money that you have left over every month after you pay your expenses, okay? So I'm assuming here, to keep it simple, that we call it gross income. Gross income is the amount of income that you're bringing in, okay? Minus expenses. So if it's 500 of expenses a month, then you got 500 of what we call discretionary income. And the goal is to have a decent amount of discretionary income, if you can. That allows you to save more, okay? So just trying to define those expenses, I've got committed expenses, and you can see what those things might be, like a car payment, utilities, a mortgage, charity, make that a committed expense. Not save, but allocate to some charitable entity is a good thing to do, right? Okay? And savings, I put that as a kind of a committed expense. And then discretionary expenses are things like dining and entertainment and clothes and food and all the stuff that makes life kind of fun, right? So those are basically the categories of expenses. So you need to include savings as a committed expense, just like I just said, okay? And then make it part of your monthly budget, okay? Time value of money. So, who in here thinks you could save $100 a month? Okay,
Right
some
now.
of you,
Right
some
now.
of you, quite a few of you. You could save $100 a month. Okay, look, if you did $100 a month, that's $1,200 in a year, of course. After over 20 years, if you get a 7% rate of return, that's going to grow to $52,000. Okay, and at 8%, at 9%, at 10%. Okay, those are pretty good. Those are pretty good rates of return. They're not guaranteed. You'd have to invest the money, right, into like that thing called a growth mutual fund, right? There's no guarantees, but if you could set up some kind of a monthly savings and let that money grow over a long period of time, that's how you can accumulate some money, okay? Questions on any of that?
That's your money working for you, and all you had to do was save it and put it to work.
Okay? Now,
A savings account doesn't grow.
right. Yes, sir.
What do you invest in, like what do you put it into?
Well, there are thousands of different mutual funds out there. So a mutual fund is just a managed account. So it's a fund where you have a portfolio manager, and he or she, or maybe a team, is managing the money in that fund. And they're buying stocks or they're buying bonds, depending on how that fund is structured, right? But for people for younger folks, it makes sense to be more in a growth-oriented fund that's in stocks. Okay, there's more risk, but there's also potential for a much greater return, right? And if you've got a long time on your side, that's the best way to go. So a lot of different mutual funds out there. You can Google mutual fund and you'll get all kinds of info, right? But that's the best way to do that, to save on a monthly basis. And you can do $100 a month into a mutual fund and just let it go and just don't touch it. It's a really, really good thing to do. This, I just went down to same scenario, just over 4 years, but different rates of return, right? Okay. All right, investment options. There's lots of different, like I just mentioned. I mean, there's literally thousands of mutual funds. There's thousands of individual stocks out there and bonds, okay? There's real estate investment trust, there's annuities, there's limited partnerships, there's life insurance, lots of different things. So it's just a matter of studying over a period of time or going to someone like myself that can help you with that stuff, right? And I'm not suggesting that you do it now, but you could if you wanted to, right? And with your parents' help, maybe they can help you to understand some of that stuff, right? But I'm thinking it's going to be more applicable maybe 4 or 5 or 10 years from now. This stuff is all going to be applicable, right? Okay?
I just want to interject and say that if some of this stuff sounds like it's over your head, this is real life stuff. This is what you're going to be dealing with. You can say, I don't understand what he's talking about. Well, I was like that. I never really understood all this stuff, but I understood the importance of it, and I knew that I needed to get my ducks in a row. I didn't do that till I was a lot older than you, and I thought, I need somebody like him, and that's what I did. I don't have time to figure out all this stuff, so that's where somebody like Kevin, and there are a lot of others out there too, figures all this stuff out and takes care of it, and they manage it. I don't have to worry a whole lot about it. He calls me and tells me I gotta do this or that.
So like you invested money for him?
Yep. I mean, so my clients, they invest money with me, and I help them with how to invest the money based on their goals, based on their age, based on what their income needs might be. You gotta factor in a lot of things to determine what's the right thing to do for them. Because not everybody's the same. Everybody's unique in what they need or what they want or what their risk tolerance is. With the way the stock market's been, this year, I've had a number of clients that are like, I can't take this. The downturns that have happened, and they're seeing their portfolio values dropping. That's a tough thing to see. So you got to put it in perspective, and my job is to make sure that people have enough cash on the sidelines, so to speak, that they can get to if they need some cash. But they're pretty much in it for the long term, right? You have to have a long-term mentality to deal with the fluctuation that can happen and realize that things can go down. But over a long period of time, the stock market has been the best place to make some pretty good money. So, okay? So I said, people can do this on their own, or they can hire someone to help them, okay? And that's what financial planning is you could, whoops, what did I do there? Okay. So, planning is an ongoing process designed to help individuals arrange and coordinate their personal financial affairs to enable them to achieve their objectives. So it's all about what the client wants to do, what their goals are. That's the focus, okay? All right, where teenagers get their money. 64% is from gifts. 32% is allowance from parents, and 22% is a part-time job. You guys have jobs? Some of you have jobs, okay? Or a combination of the above, where teenagers get their money, okay? Where teenagers spend money, average of $2,150 a year, okay? So just to give you some perspective of where teenagers generally spend their money, okay? You can see that. Now think about taking $2,000 a year and putting it into some account that makes 8%. That can grow, right? I'm not suggesting that you do that, but 5 or 10 years from now, that would be the thing to do, okay? So debit card, when are we done? 5 minutes?
What do we got?
Yeah, 5.
About 5?
Okay, we're still good. So debit card versus a credit card. So a debit card, who in here has debit cards? Pretty much, right? Y'all have debit cards. And a few of you have credit cards. So, debit cards are much more used than they ever were in the past. But this is a simple little comparison of debit cards versus credit cards, okay? Under credit card, at least 30 days. So you've got some time to pay on a credit card, right? And that's a nice thing. At least a minimum payment every month, and it's a high interest cost, right? Whereas a debit card, it just comes from the checking account and it's done. So I kind of like both of them. They're both convenient and kind of necessary. Okay, just a matter of you just got to understand them, right?
Don't
All right.
let them get away from you.
Right. Okay. So, time is your friend. Use your time ahead to reach your goals. I mean, that's important. So the best advice. This is about the last that I got. This is it. So live below your income. So when you get, let's say you're going to go on to college, and you're going to graduate in 4 years or 5 years, and you're going to get out and you're going to make your first job, and you're going to be making $60,000 a year. You need to, based on that 10%, you need to save at least $500 a month. It'd be a good thing to do, right? Okay? So live below your income. That's important. Save at least 10%. Right now, you could probably save a lot more than that. Pay yourself first. So it's the same concept. You're paying yourself first, right? Putting some money aside, okay? Delay gratification. You don't have to do it forever, but delay it, right? It's a good thing to do. And make savings automated. So the idea is you have $100 a month or $200, whatever it is, it's a direct payment out of your checking account to wherever you're saving it. Make it automated. Banks, they do it all the time. You can do that. So you don't have to, it's not a manual transaction, okay? It's a good thing to do. And then I say here, meet with an expert who you trust, or become your own expert. Do it yourself if you want to, if you can. A lot of people do that, okay? That's it. We good? Couple minutes? What about any questions? I've done most of the talking. Yes?
So on a credit card, do you have 30 days to like pay the exact amount, or is the 30 days being like is there, I don't remember the word.
Well, there's a
Minimum.
I know, but like, what's that word where they add money on? Interest. Is
there's
there
an interest.
on 30
No,
days?
there's no interest cost if you get it paid by the due date on that statement. So they generate a statement at the same time every month. But you might put money on a credit card on the 1st of the month, and the statement is generated on the 15th, right? And you have to pay by the following month on the 15th. You've got 45 days where you're not paying any. You didn't pay anything. I mean, that's a pretty nice little gig, really. But you either have to make a minimum payment by that due date, or you pay the whole thing off, and I'm recommending you pay the whole thing off by that due date. If you're late, by the way, if you're a day late on a credit card payment, right, they could charge you $30 just for being a day late. So you got to be mindful. You got to read the statements and be mindful of that. But that's a good question. Yeah. Anybody else?
This is stuff you're gonna deal with. Remember, you need to do a takeaway on what Mr. Keane was talking about. I will look for that on Monday.
Have a great day, everybody. See ya. Thank you.